The conflict in Ukraine has added to the uncertainty that has already plagued the stock market this year. In the midst of a battle with no end in sight and rising sanctions on the side of the US and its European allies, the S&P 500 saw its biggest one-day decline since May 2020. With hundreds of civilians killed, including children, and over 500,000 refugees fleeing Ukraine, the human cost is undoubtedly the most important result, rather than anything related to people's assets. As the battle drags on, the unpredictability of the implications beyond Ukraine's borders grows. Before we get into the video, allow us to mention that nothing mentioned in this video is financial advice, and we are not financial advisors. We would recommend you ensure that you conduct a due diligence process before making any decision that may affect your financial portfolio. If you are looking forward to seeking external advice, head out to your trusted financial advisor, who has a clear idea of your financial situation. Having said that, let us get into this video. How does the Ukraine and Russia conflict impact the stock market? One way to really see the impact on the economical world is the fact that the Moscow Stock Exchange was closed for almost a month. The stock market in Russia's capital only started opening again in the week of March 21st, and the Russian ruble plummeted to new lows amid increased sanctions against Russia. The ruble even hit a new low of over 140 per dollar in Moscow. After the invasion, the S&P 500 index experienced its first correction in nearly 2 years, dropping more than 10% from its recent high, and despite the uncertainty about what would happen next, the stock market in the United States rapidly recovered. While the human consequences of the conflict are drawing the world's attention, the financial repercussions are more convoluted. According to many analyst interviews, for the time being, experts say the strength of NATO and European nations' responses has quelled fears that Russia's invasion on Ukraine could send global markets into a tailspin. When the market begins to fall, investors may be tempted to sell their investments prematurely, but experts advise against it. Not withdraw your funds. Don't give up on your investments. According to several personal finance experts, any reaction from you to the situation in Ukraine will most likely injure you more than it helps you. The stock market's recovery demonstrates that investment volatility is normal, and investors need not be alarmed. Of course, the lives lost and the destruction caused by conflict are always more significant than the fate of our investments. May this problem be resolved quickly and peacefully. However, as the issue unfolds, we'll discuss what you should do. What's going on in the stock market? And how is the Russia-Ukraine conflict affecting the stock market? The general market has recently reacted to rising interest rates, a 40-year high in inflation, the ongoing pandemic, and, most recently, the horrific situation in Ukraine. If you have liquidated your stocks after the Russian invasion, you most likely have lost the market. It's human nature to respond, and we're seeing that play out right now in the stock market. Remember that the market has more than doubled since the start of the COVID-19 pandemic, when it dropped more than 30% in March 2020. Is the stock market about to collapse? As you probably would have guessed, we simply don't know. No one knows, as all of this is mainly because of information that is known to the public already. The market will probably not collapse, at least in terms of history. However, wars frequently have an impact on the stock market. The stock market climbed in the 10 years following the outbreak of war in the last 6 US-led wars. The worst came during World War II, when the market only quadrupled in the 10 years after the initial breakout in 1939, and the best was during the Gulf War, when it increased by about 500% from 1990 to 2000. If the entire stock market collapsed, no publicly traded companies in the United States would make a profit, and if that happens, the consequences for civilization would be far worse than just a financial loss. We can't say whether or not the market will crash, because it's already based on all publicly available information. It'll do what it's going to do, which is most likely up, as it has always done. Should investors alter their strategy or withdraw their funds? Simply change nothing. That is by far the best strategy to work around the Ukraine-Russia stock market impact. We advise staying the course, sticking to your goal, and buying and holding index funds. Plan to keep your investments for decades. Don't try to time the market, and don't sell anything until you've reached retirement age. The stock market's volatility, on the other hand, serves as a reminder of why it's critical to have a robust emergency fund in cash before investing. That way, you'll have safe and secure money that you can access at any moment, even if the value of your investments fluctuates. So stick to your long-term financial goals, such as saving, debt repayment, and investing. The best thing you can do right now is to stick to your habits and invest at regular intervals. It simply all comes down to keeping your investments aligned with your strategy. Start early and invest often, even though we feel the pain of the recent drop too, but to react emotionally to an event like this is probably the worst thing to do. So, that is our analysis about the Ukraine-Russia war impact on the stock market. Thank you for stopping by to watch. Please consider giving this video a thumbs up and subscribing to the channel. Make sure the bell notification is turned on so you don't miss any new information from us. Also, don't forget to share your investing opinions. In our next one, we'll see you all again.